Dear students, in the previous session we have studied about meaning and definition of partnership, essential features of partnership, partnership deed and its contents, and special aspects in the case of partnership accounts. In today's session we will look at the first special aspect of partnership accounts, that is maintenance of capital accounts of partners. In the last year you have studied about different aspects of accounting in accountancy, that is journal, subsidiary books, ledger accounts, trial balance, and preparation of final accounts. So you studied all these aspects from the point of view of a sole proprietorship. When we talk about accounting for partnership, most of these aspects are same as in the case of sole proprietorship, but there are some special aspects which are we are studying in this second year accountancy. In that, first aspect is maintenance of capital accounts of partners. So in the case of a sole proprietorship business, there will be only one owner or proprietor. Therefore we will open one capital account in his name and write all transactions taking place between him and that firm. Coming to the partnership, since there are many partners, we have to open many number of accounts, that is each account for each partner, and we have to write all those transactions taking place between partners of that partnership firm and the partnership firm. So let us see what are those different transactions which we are going to record through the capital accounts of partners. Total there are 7 such transactions. Let me read out. The first transaction is capital contribution by partners. Second is withdrawal of capital by partners. Third one is drawings by partners. Fourth one, share of profit or loss. Fifth, interest on capital. Sixth, interest on drawings, and the last is remuneration to partners. So these 7 transactions will be recorded through partners capital accounts. Here let us understand the nature of these transactions. Coming to the first 2 transactions, or we can call them adjustments also. First 2 transactions are they take place very rarely in the firm, that is capital contribution by partners and withdrawal of capitals by partners. When firm is new, at the time of its establishment, partners may, or that means partners will contribute capitals. We call initial capital contribution. Later, whenever they require more capital for the activities of business or for the expansion of business, then they may introduce additional capital during that year. Coming to the withdrawal of capitals here, in rare cases partners may feel they have surplus capital than what they required. So in such a case they may decide to withdraw surplus capital from the firm. So that is what withdrawal of capital by partners is. So these 2 transactions do not often take place in any partnership firm. Maybe we can see once in 3 years or 4 years time, and so on. Therefore these 2 transactions are not recurring often year after year, and like that. Coming to the remaining 5 transactions, drawings, share of profit or loss, interest on capital and drawings, and remuneration to partners. So usually these are recurring in nature. They often take place in the case of any partnership firm. Now about recording these transactions through capital accounts of partners. We have two systems or methods of maintaining capital accounts of partners. How we record these 7 transactions depends on the method or that system which is followed in that partnership firm. So what are those methods? First method is fixed capital system or method. Second is fluctuating capital system or method. So depending on the method, fixed or fluctuating, we are going to record these 7 transactions. Let us understand what is this fixed capital system is. The name itself says fixed capital. That means under this method, balances of capital accounts of partners will remain same or fixed from year to year or year after year. That means the balances in their account will not change or remain unchanged year after year. That is why we call this system or method as a fixed capital system. Let us understand why that balance remains same or fixed from year to year. So again we have to list the transactions. Let me list out all those 7 transactions. The first is capital contribution by partners. Second one is withdrawal of capitals by partners. Third one is drawings. Fourth one is share of profit or loss. Fifth one, interest on capital. Sixth, interest on drawings. And the last one, remuneration to partners. Now, under fixed capital system, the first 2 transactions or adjustments will be recorded in capital account of a partner, and remaining 5 transactions are recorded in current account of that partner. Let us understand the reason behind this. As we said, capital contribution and withdrawal of capital take place not very often. They are recorded in capital accounts only. Whenever there is capital contribution or withdrawal of capital, that will affect the balance in that capital account. Remaining 5 transactions often take place in the firm. So these transactions are recorded in a separate account called current account. So whenever such transactions are there, they are recorded in the current account, and that will affect the balance in that current account. Therefore, under fixed capital system, each partner will have 2 accounts. One is capital account another is current account. Since these recurring transactions are recorded in the current account instead of recording in the capital account, capital account balance of any partner under this system will remain same from year to year, unless there is additional capital contribution or withdrawal of capital in that accounting period. That is why that name has come, that is fixed capital system or method. Now coming to the nature of balance shown by current account and capital account under fixed capital system. So under fixed capital system, capital account will always show credit balance, and therefore it will be shown on the liability side of balance sheet. On the other hand, current account of any partner may show either debit balance or credit balance. That purely depends on the all those 5 transactions which are recorded there. So if there is debit balance in that current account, it will be shown on the asset side of balance sheet. On the other hand, if it is current credit balance, then it will be recorded on the liabilities side of balance sheet. Let us look at the formats of partners capital account and partners current account under fixed capital system. So first we will look at the capital account. So under capital account, we will be recording only 2 transactions. One, capital contribution by the partner, another withdrawal of capital. So on the credit side, we will be recording capital contributed by that partner as a cash or bank account. On the other hand, suppose surplus capital is withdrawn by partner is there, it will be recorded on the debit side as a cash or a bank account. Only first 2 transactions will be recorded in partners capital accounts, and it will be total, and we have to find out balances. So unless there is additional capital contribution by the partner is there, or surplus capital withdrawn by the partner is there, the balance in the capital account of any partner will show or will remain the same from year after year. Now coming to the partners current accounts. So remaining 5 transactions are recorded in partners current account under fixed capital system. So we will record all those transactions and look at the format of current account. So the first thing is drawings made by the partner. So drawings made by partner will be recorded on the debit side of partner's current account. Next, interest on capital is recorded on the credit side. Then interest on drawings on the debit side. So we can remember journal entries. For drawings, entry will be partner's current account debit to drawings account. On the other hand, for interest on capital account debit to partner's current account. On the other hand, for interest on drawings, partner's current account debit to interest on drawings account. After that, we have remuneration to partners like salary or commission. For that, salary or commission account debit to partner's current account. That will come on the credit side of current account. After that, last one, that is share of profit or loss to the partners. Suppose there is a share of a profit to that partner, then it will be recorded on the credit side as profit and loss appropriation account. Journal entry will be profit and loss appropriation account debit to partners current account. On the other hand, if there is a share of loss, then partners current account debit to profit and loss appropriation account. So this is how partners current account appears under fixed capital system. So the point here is, under fixed capital system, capital balance will remain same from year after year unless there is all those two transactions, capital contribution by partner and surplus capital withdrawn by the partners, because all other transactions are recorded in a separate account called current account. Coming to the second system, that is fluctuating capital system. Let us understand what is this system. So under fluctuating capital system, the capital balance of any partner remains change. ಒಂದು ಪಾಸ್ ಆಯ್ತಾ ಇದು? So coming to the second system, that is fluctuating capital system. Here the capital account balance of any partner will fluctuate from year after year, because we are going to record all those 7 transactions in only one account, that is capital account. In this system, we will not prepare current accounts for partners. Let us understand how or why the capital account balance will change from year after year. Coming to all those 7 transactions, all those 5 transactions, that is drawings, share of profit or loss, interest on capital, interest on drawings and remuneration to partners. So these transactions will be there recurring in nature, or year after year we will get all those transactions, and we will be recording these transactions in capital account only, and remaining those 2 transactions, capital contribution and surplus capital withdrawn by partner, will not take place often. So whenever they are there, we will be recording them in the capital account. Because of remaining 5 transactions, capital account balances will fluctuate from year after year, because every year we will record all those transactions through capital accounts. So that is why that name fluctuating capital system has come. So let us look at the format of partners capital account under fixed capital. So let us look at the partners capital account format under let us look at the format of partners capital account under fluctuating capital system. So we will be recording all 7 transactions in one account only, therefore amount of balance will change from year after year. So first, cash or bank account on the credit side for capital contribution by partner. Second is withdrawal of excess capital or surplus capital on the debit side as cash or bank account. Then drawings we are going to record on the debit side. Next, interest on capital on credit side. Next is interest on drawings on the debit side. After that, salary, commission to partners on the credit side, and last, share of profit or loss. If there is a share, we will record on the credit side as a profit and loss appropriation account. If there is share of loss, we will record that on the debit side as a profit and loss appropriation account. So all 7 transactions are recorded in one account only, that is partners capital account. Therefore, balance in that account will change from year to year. Balance will be fluctuating from year to year. So this is what fluctuating capital system is. After discussing fixed and fluctuating capital systems, let us understand the differences between fixed and fluctuating capital systems. So the first basis of difference between fixed and fluctuating capital system is number of accounts. So under fixed capital system, we will be preparing 2 accounts for each partner. That is, one is capital account, another current account. Coming to the fluctuating system or capital system, we will be preparing only one account for each partner, that is capital account only. That is the first difference on the basis of number of accounts to be prepared for each partner. Second basis is adjustments. So here adjustments mean those 5 transactions: drawings, interest on capital, interest on drawings, remuneration, and share of profit or loss. So these 5 transactions or adjustments under fixed capital system will be recorded under current account. That is the first difference. Coming to the fluctuating system, those 5 transactions will be recorded under capital account only. Next, third difference is nature of balance in capital account. Here, under fixed capital system, capital account balance will remain fixed, whereas under fluctuating capital system, capital account balance will be fluctuating. That is the third difference. And the last difference is credit balance. That is, under fixed capital system, capital account of any partner will always show credit balance, whereas under fluctuating capital system, capital account may show credit balance or debit balance. So, these are the four differences or distinction between fixed capital and fluctuating capital systems. Let us look at one illustration problem to understand fixed and fluctuating capital systems. I will read out the question. Samir and Yasmin are partners with the capitals of rupees 15 lakh and rupees 10 lakh respectively. They agreed to share profits in the ratio of 3:2. Show how the following transactions will be recorded in the capital accounts of partners in case the capitals are fixed and the capitals are fluctuating. The books are closed on March 31st every year. Details are given here. Particulars, amount column, one for Samir, another for Yasmin. Additional capital contributed on July 1st 2014, 3 lakh and 2 lakh. Interest on capital 5% each. Drawings during the year 2014-15, 30,000, 20,000. Interest on drawings 1,800 and 1,200 respectively. Salary to Samir 20,000. Commission to Samir 10,000 and to Yasmin 7,000. Share in loss for the year 2014-15, Samir 60,000 and Yasmin 40,000. So, this is the question. So, we have to prepare partners capital accounts under fixed system as well as fluctuating system. So, we will prepare capital account and current account under first case, that is capitals are fixed, and later we will prepare capital account under capitals are fluctuating. So, before going to the solution, let us understand the question clearly. There are two partners, Samir and Yasmin. Their capital account balances are given. Samir has 15 lakh opening capital balance and Yasmin has 10 lakh in his capital account. Their profit sharing ratio is given, that is 3:2, and different transactions of that year is given. Now, coming to the first point, that is additional capital contributed on July 1st 2014. So, they have contributed additional capital during the year, that is why we have that transaction which not often take place in any partnership business. So, here Samir has contributed additional capital worth 3 lakh and Yasmin rupees 2 lakh on 1st July 2014. So, looking at the date, let us understand the accounting period first. So, in this case, they have mentioned accounting period as 2014-15. That means accounting period starts on 1st April 2014 and it ends on 31st March 2015. So, in the case of calculation of interest on capitals, we have to be careful regarding the date and time. Let us calculate interest on capital first and later we will prepare all those accounts. So, regarding interest on capital, So we have to look at opening capital of partners, additional capital contributed by partners, rate of interest on capital and time. So coming to the first partner, Samir, he has opening capital of rupees 15 lakh. In that or on that we have to calculate interest at 5% per annum. Since it is opening capital, that capital will be there throughout the year or full year. That is why on 15 lakh we have to calculate interest on capital at 5% per annum for the full year. That will come to 75,000. And in addition to that, he has contributed additional capital rupees 3 lakh on July 1st, 2014. So on that 5% per annum for the time period. So accounting year ends on 31st March 2015 and additional capital was introduced on 1st July 2014. So we have to count how many number of months are there. Since it is July 1st, from July we have to count till March 31st. So July, August, September, October, November, December, January, February, March. Total 9 months are there. So 3 lakh into 5 by 100 into 9 by 12. That amount comes to 11,250. So total interest on Samir's capital will be 86,250. Coming to the Yasmin's case, so Yasmin has 10 lakh capital on date of opening of that accounting period. On that at 5% for the whole year, interest will be 50,000 and he has contributed 2 lakh as additional capital. On that 5% per annum for 9 months. Interest will come to 7,500. So total interest on Yasmin's capital will be 57,500. So after calculating interest on their capitals, let us prepare partners capital account and current accounts under fixed capital system. So we have prepared partners capital accounts and partners current accounts. So let us record all those transactions in their respective accounts. So first we will record opening capitals of Samir and Yasmin. So these opening capital balances will be recorded in their capital accounts on the credit side. Balance brought down. Samir 15 lakh, Yasmin 10 lakh. Next, on July 1st, 2014, they have contributed additional capital. So that we have to record on the credit side as bank account. Samir has contributed 3 lakh and Yasmin has contributed rupees 2 lakh. And in this problem, there is no withdrawal of surplus capital by Yasmin or Samir. Therefore, we can total the capital accounts and find the balance itself. the total will be here. Now on the credit side total is greater because on the debit side we don't have any items. Samir's column will be, it is 18 lakh. On the other hand, Yasmin's case it is 12 lakh. So we will record that totals on the debit side and we will record closing balance as balance carried down, 18 lakh, 12 lakh. In this problem, their balance in capital accounts has changed. For example, in the case of Samir, he had opening balance 15 lakh, but he has closing balance 18 lakh. That is because there is transaction relating to additional capital contribution. So unless there is transaction, that is capital contribution or surplus capital withdrawn, the capital account balances will remain same. Next, coming to the partners' current accounts, all those remaining transactions will be recorded under their capital accounts. So we have two columns on each side, one for Samir, another for Yasmin. So instead of preparing separate accounts, we can prepare as a consolidated current accounts. So under current accounts of partners, first we are going to write is drawings made by Samir and Yasmin. So that will come on the debit side. Drawings. So Samir, it is rupees 30,000. On the other hand, Yasmin 20,000. Next, interest on capital on the credit side. We have already calculated interest on Samir's capital will be 86,250 and interest on Yasmin's capital will be 57,500. Next is interest on drawings on the debit side. In the problem, interest is already calculated and given directly. Interest on Samir's drawings is 1,800. Interest on Yasmin's drawings is rupees 1,200. Next is salary and commission. So salary on the credit side for Samir only, it is 20,000 and Yasmin is not going to get any salary. Next is commission to both partners. Samir has 10,000 and Yasmin 7,000. And the last item is share in a loss for the year. So when there is profit, we will record on the credit side. In this case, we have loss, share of loss. Therefore, we will record on the debit side. So share of loss is recorded as profit and loss appropriation. Account. Samir's share of loss is 60,000 and Yasmin's share of loss is 40,000. So next we have to add up to find out the totals in current accounts and find the balance. So first we will find the balance of Samir. On the credit side we have 86,250, 20,000 and 10,000. So total comes to 1,16,250. On the debit side we have 61,800 plus 30, 91,800. That means credit side total is greater than debit side total. So first we will record the credit side total 1,16,250. Write that total on the debit side 1,16,250. Then deduct the items on the debit side. For that we have to calculate now 1,16,250 minus, so here 91,800 amount comes to 24,450. Write as a closing balance carried down. Now coming to Yasmin, credit side we have 64,500, debit side we have 61,200. So here also credit side is greater than debit side total. 64,500 from 64,500 deduct 61,200. Balance is 3,300. So this is how partners capital accounts and partners current accounts come under capitals are fixed. Let us look at the partners capital accounts under fluctuating system. So under fluctuating system we will be preparing only capital accounts. There is no current accounts required to be prepared. All transactions will be recorded through capital accounts only. So first we have two columns each side, one for Samir and another for Yasmin. We will record all transactions through their capital accounts now. First we have to write the opening balance of Samir and Yasmin as balance brought down. Samir has 15 lakh capital and Yasmin has 10 lakh. Next, additional capital contributed by Yasmin and Samir. So as bank on the credit side, Samir has contributed 3 lakh additional capital. Yasmin has contributed 2 lakh additional capital on 1st July 2014. Next, on the debit side, we will write drawings made by partners as drawings account. Samir 30,000, Yasmin 20,000. Next is interest on capital. We have already calculated interest on capital of Samir and Yasmin. So Samir gets rupees 86,250 as interest on his capital, whereas Yasmin gets 57,500 as interest on his capital. Next is interest on drawings. On the debit side, 1,800 for Samir, 1,200 for Yasmin. Next is salary to Yasmin. It is 20,000. Next, commission. So commission to Samir is 10,000 and Yasmin 7,000. And the last, share of loss on the debit side as profit and loss, appropriation account, 60,000 for Samir, 40,000 for Yasmin. We have recorded all transactions through their capital accounts only, because this system is fluctuating capital system. Let us total the credit and debit side and find out the balance. So on the credit side, Samir has total worth 19,16,250. So we have to add up all the items on the credit side. We get 19,16,250. Write that on the debit side, because on the debit side we have less amount than the credit side total. So if you deduct debit side items from that total, we get a closing balance. We have to write as balance carried down, and balance will be 18,24,450. On the other side, total of Yasmin's account comes to 12,64,500. Write that on the debit side. From that deduct debit side items 61,200, you get 12,03,300. So this is how under fluctuating capital system partners capital accounts appear. So that's all for today's class. There is 2 numerical questions for your homework, which is given in the description box.